Okay, so welcome again to this session of NISM 21A, which is PMS. So let's start our discussion. So if you see the examination structure has 80 questions of 1 mark each. So that takes it to 80 marks. Then you have got 3 case study based questions, 2 case studies of 5 marks with 1 mark each questions, and 1 case study of 5 questions with 2 marks each, taking it to 20 marks. So totally 80 plus 20 would be 100 marks. There is a negative marking, which is 0.25% negative for each wrong answer which you attempt. There is no negative marking if you have skipped a particular question. Okay, so if you don't attempt, there's no negative marking. You attempt and it is wrong, it is minus 2.25. 60% is the passing. So all of those who have given exams with 50% passing realize that that is difficult. When you move that passing percentage to 60%, it becomes more difficult for all of us. And if you add to that negative markings, it becomes very, very difficult. So one thing is very clear, that you will not be able to randomly mark answers where you don't have absolutely any clue on the question. You will not be able to do that. Second, you can't leave out a lot of questions also, because there could be a possibility of mistakes. And if you leave around 30 questions or something like that, then it will be a very, very tight situation for you, because whatever you attempt has to be perfect. No mistakes in that, or very minimal mistakes in that. So that has to be taken into account. So what is important here is that we study. There is no alternative to it. We have to prepare. So what we prepare, I'll discuss that with you, and ensure that whatever you have studied, you've understood things, because there are some questions which are direct questions, some questions which are indirect, which is application questions. There are numericals or sums also in this. At the same time, there are case studies also. So if you do not understand the concept, it will become very difficult. Plus, there'll be small things which will be picked up from the book and will be put into questions. So for that, you will also need to read the book. So efforts have to be put in. Whoever has given the exam, whether passed or failed, we have discussed with them, and the only input which we've got is, this is not easy. You'll have to do your homework, you'll have to do your preparation, you'll have to put in time and effort, then only clearing this exam is going to be possible. Okay, and we don't have much time left with us, because it's 7th of September, by the end of which we have to clear this exam. Now, if you look at the chapter wise weightage, chapters 7, 8, 9, and 10, these are the most important chapters, which totally constitute to around 52 marks out of the total 100 mark paper. Then you have the chapter 12, which is the regulatory framework, which is again important. And from the non-PMS side, that is the first 6 chapters, chapter 3 and 4 become very important, because you have sums coming out of that as well. A complicated chapter could be derivatives and taxation. But derivatives, you can still try and attempt. Taxation, if you feel some basic things you're able to understand, you want to leave the rest, that's still okay, because the total weightage is just 5 marks. Okay, so this is the weightage chapter wise. What we have done from the training department is, we have created a flyer. Now this is a 1 single page PDF which consists of every possible input which you might want for your preparation. So we have mock test 1 to 4. Each mock test is of 100 marks with negative marking. What happens here is that, because of the negative marking incorporated into this mock test, you get a fair idea of what will happen in the paper. Okay. Next is mock test number 5, which is a special mock test for case studies, because reading a question, answering that sometimes is easy. Reading a case study which has got a lot of parameters, a lot of values given in it, and then looking at the question and finding out what needs to be picked up from the case study might be a little challenge, unless until you have prepared yourself for it. So that is where the mock test 5 would come into handy. Then we have the study material in terms of numericals. So whatever numericals are there in the book, we have tried to incorporate that in the form of the numerical study material which is there. So you don't have to go anywhere else. Next is ethics. Ethics is also not easy. So To give you a hang of it, what is required there, and how do you remember things, we have a special study material on code of ethics. A lot of people asked about important questions, so we have a separate note on important questions. What happens is you go through the questions, they're available on a link. End of it, you click on the next button, the next entire file opens up. Okay. Last but not the least, if you want to have a recording of the session, it is already available on our playlist in the ProStart channel. So the entire session, which was done on 17th of December 2022, has been recorded and uploaded on the YouTube channel already. Now, all of this is just at the click of a button. You don't have to take anybody's permission. You don't have to let us know that you're doing it. It is there. You want some reference from our side, help from our side, we're more than happy to do it. So a lot of efforts have been done to ensure that you clear the exam. So please go ahead and prepare completely using all the material. And then I hope you clear these exams. So what we are going to do is today, we are looking at this session flow is slightly changed, so I'll not go through the session flow. So this is the syllabus consisting of 6 non-PMS chapters, which is chapter 1 to 6, and the PMS chapters, which are 7 to 12. Now, you might see people saying that, okay, leave the first 6 chapters, just focus on the rest 12, the rest 6. No, you shouldn't do that. Obviously, the 7 to 12 is important because that constitutes around 66% of your scores. But the first 6 chapters are equally important. Now, just imagine if the first 6 chapters are coming for 35 marks and you're able to score 100% there. So what is expected from you is just 25 marks from the rest 65 questions. Life becomes easier, right? So what is your forte? Your forte is already first 6 chapters. So ensure that you do that. And at the same time, you work on the last 6 chapters also. One chapter here and there, small chapter, 5 marks, 8 marks, you leave as an option, it's still okay, but don't leave more than that, because simpler questions might come from difficult chapters also. Classic case is numericals. We have seen that simple sums come, but because people leave sums, they're not able to score on those as well. Coming to our first chapter, which is chapter on investments, chapter 1. So what is the objective investment? Normally, if you look at investor goals, they are into 3 parts. They have 3 parameters to it. One is the risk parameter. Second is the returns parameter. And the third is liquidity preferences. So obviously, risk and return being the same, liquidity will change the situation and change the products for the person. For example, I have a particular risk return profile, but I need money for my child's education anywhere between 6 months to 12 months. My product of choice will be different. Whereas my planning for my retirement, the liquidity is not required right now, so my products will be different, though the risk return matrix for both is the same. So return objectives in the book have been classified into 3 categories: capital preservation, capital appreciation, and current income. What is capital preservation? So to avoid chances or minimize chances of capital erosion. Now, I have certain money which has been accumulated for my child's education already there, because I need it anytime now. Would I want to risk that already achieved money by putting it into equity markets? The answer would be no. My primary objective would be that capital erosion shouldn't happen. Rest all is fine. Okay. So typically, a short-term investor is one person who would invest for capital preservation. The second category of customer is somebody who is high risk averse. I have been investing in FDs for years and years together now, post office products. So I don't understand equity, and I am not willing to put my money into equity. I am not ready to take any risks. I don't want volatility. So for me, capital preservation would be a good option. Second is capital appreciation. Most of us are in this category. because we still have a lot of working years ahead of us. We want our portfolios and our investments to grow over a period of time. We are ready to give time to our investments. We are ready to take certain risks associated with investments. So that is where capital appreciation plays a major role for us. The third category is current income. Let's say there is a retired person. What is his objective out of investment? His objective is that the income is generated through this investment on a regular basis. He is not concerned with capital appreciation. He wants monthly income to take care of expenses. So typically, a target audience could be retired individuals. Another category could be that somebody who's working or has a business and wants to branch out into something different. That cooling off period which is required before the business actually takes off, he or she would need to support the family for the expenses which are there. That is the time also a person would probably want a current income. So capital preservation, capital appreciation, current income, overdone. Next, let's look at a concept which is known as required rate of return estimation. This is slightly different from the normal way in which we look at things. Now understand here that a person is not consuming today in the view that he will be able to consume more tomorrow. So he postpones his current consumption of 100 rupees for a consumption of 102 rupees in the future. So here this 2%, which is 102 upon 100, is the pure rate of interest or the real risk-free rate. Now, obviously, a normal rational investor would not be satisfied with only a pure rate of interest. He or she would want more. That is inflation adjustment and uncertainty adjustment. So this pure rate of return is what is demanded in absence of inflation and uncertainty. Now, the real risk-free rate plus inflation adjustment is nominal risk-free rate. And the nominal risk-free rate plus the risk premium is the required rate of return. Now, when we talked about the real risk-free rate, the person is only looking at compensation for postponement of consumption. That's it. The second parameter which comes into place is compensation for inflation. And the third which comes into the place is compensation for uncertainty of cash flows. That is the risk free. So these are the three components of any returns which you receive in the market. Now let's take an example here. Rima wants to invest rupees 100 for 1 year. Expected rate of returns is 10%. Price level increase or inflation is 8%. What will be the nominal risk-free rate? So here what do we do? NRR, which is the nominal risk-free rate. The formula is 1 plus real rate of return multiplied by 1 plus expected rate of return minus 1. Here the real rate of return is not the RRR which we calculate in the time value of money. That's different. So it is 1 plus 10% multiplied by 1 plus 8% minus 1. That is 18.8%. Okay. Now such simple sums come. If you don't know the concept of NRR, you'll not be able to attempt it. If you've decided not to attempt any numericals, then also you'll not attempt it. Otherwise, this is a piece of cake. Types of risks. So initially you have the business risk, which is there. This is caused by the firm's, by the nature of the firm's business. So the kind of business you are in, that itself will get certain business risks associated. At the same time, sales volatility and operating profits, operating leverages also determine the level of business risk. Sensitivity of businesses to business cycle. So sometimes some businesses are cyclical in nature, that is, are sensitive to business cycles. So that also adds a certain amount of business risk. So by the nature of business, volatility, operating leverages, and business cycle, whatever risk comes in is known as your business risk. Next is financial risk. So how do you finance your company? Do you go for equity? Do you go for loans? Or do you go for debt? These are the broad three ways in which anybody can finance the company: equity, debt, and loans. Now, if you're using debt financing, what happens? The coupons will have to be paid, the principal amount has to be paid. So all of these precede the stockholder payments. That is, they are done before you pay to the stockholders. So this directly increases the stockholders' income and adds up to the financial risk for the organization. Okay. Types of risk continued. So you have liquidity risk. Liquidity, everybody understands. What is liquidity? The ease of converting anything into cash and cash equivalent. What is liquidity risk? The more difficult things are, you find things to be converted into liquid, it is more difficult. That is more liquidity risk. Treasury bills, or the T-bills which are there, they have practically zero liquidity risk because there is nothing which stops you from trading them. Okay. Similarly, a piece of art, a sculpture, a painting, these have very high liquidity risk, because if you get a buyer, fine. If you don't get a buyer, you cannot do anything. Regulatory risk, everybody of us understands what it is. So uncertainty associated with a regulatory framework pertaining specifically to the investments, because that is what we are concerned with. So regulators like SEBI, IRDA, RBI, PFRDA, all of these put up some regulations of the other, and that increases the risk in the business. So that is your regulatory risk. Also, importantly, if you have an established product or an established market or an established industry, the regulatory risk will be less, because whatever the regulators wanted to do, they've already done that. But if you are looking at new investments, new industry, new companies, new sectors, new business opportunities, the regulatory risk might be higher, because as the regulator tries to understand things, they try to put things into place and put the rules into place. So they may be continuously throwing up different regulations to ensure that investor safety is taken care of. Political risk, anything which arises from major changes in political environment in the country. So lack of stability in the center, at the states, communal riots, etc., increases the political risk. Now, if there's somebody who's investing in an unstable country, which has political issues, economic issues, they would want a country-specific risk premium associated with it when they are going for returns. So if I'm investing in any country, probably I would want a country-specific risk premium associated with it. Then you have geopolitical risks. So impact of geography and politics on economics and relationships and trade between countries, that is your geopolitical risk. So here you have wars, tensions, then overall terrorist activities, and so on and so forth. Geopolitical risk would assume greater magnitude if you're talking about sanctions or embargo. What is sanctions? A particular country is banned from doing certain activities with other countries, particular trade, particular thing, etc., etc. So that will have an overall impact, because every country provides certain sort of raw materials or is a market of finished goods for multiple countries in the world. So the sanctions would play a vital role there. What is embargo? Embargo is one level higher than sanctions. What happens here? Overall, a country is banned. So we were looking at embargo almost towards Russia in the Ukraine-Russia war. Did not happen. But if it would have, then it would have escalated things to a different level altogether. That is that, but no other country is allowed to deal with that country for anything. So that's a higher level of sanction. Exchange rate risk. So if you're dealing in any other currency beyond INR, whether it's dollar, whether it's yen, whether it's pounds, whatever it is, that would automatically include a exchange rate risk which is there. So we've given an example here. An Indian investor invests in dollar-denominated bonds. The interest will be paid in dollars. If the rupee appreciates versus the USD, the interest received converted into INR will always be lower. So if you've not understood this entire line, simple, remember, rupee appreciated means loss when you convert that into INR. Rupee depreciated means profit when you convert that into INR. So for all people who get money in foreign currencies, which are in higher denomination as compared to rupee, and rupee depreciates in front of them, they're happy because they are making money in that particular investment in that country. Plus, they're also getting the advantage of rupee depreciation. Clear? Types of investment, if you have to see, you have fixed equity, fixed income instruments, and real estate. All of us know these, so I'm not getting into it. Coming to commodities, now commodities also every one of us knows, but there's a point in the book which I wanted to highlight. There is something known as soft commodity and hard commodity. So what is the ideal difference? Hard commodity is something which is mined. So if you get that commodity by mining, then it is hard commodity, otherwise it's a soft commodity. Examples of soft commodity: corn, wheat, soybean oil, sugar, etc. Example of hard commodities: gold, silver, copper, aluminium, etc. Oil also. Now, why people deal in commodities? Because they have absolutely very, very low correlation as compared to stocks and bonds. So it's ideal diversification strategy. Okay, so they have absolutely low correlation there. If you talk about hard commodities, their prices are determined by the global demand and supply. So even if India is not demanding silver, if there's a global demand for silver, people who invest in commodity like silver will make money. Coming to structured products, these are customized and sophisticated products. You are allowed to use derivatives here to create the exposure which is required. These are high risk, high return products suitable only for matured investors. So understand, high risk does not always relate to high return, but this is slightly a high risk, high return product where a retail investor would or probably would not understand much of it, and that is where you need a matured investor. Next in the list is distressed securities. What are these? These are securities of companies that are in financial problem, distress, and are nearing bankruptcy. So they may be traded at a discount as compared to their intrinsic value. What is intrinsic value? If you have studied fundamental analysis, you will know that we study FSAs, which is financial statement analysis, with the view that I'm able to find out what is the actual price value of that company. Value of that company divided by the number of stocks it is floating will give me the intrinsic value per share. Currently, the stock may be trading way above this or way below this also. But the logic is that eventually the stock price will converge back into the intrinsic value on a longer run. So that is where we are interested in the intrinsic value. So these distressed securities would be probably trading at much higher discount as compared to the intrinsic value, hence a buying opportunity. They are also considered as fallen angels. Now, till all of these 3 points, we've always talked about distressed securities as positive and as an opportunity. Why? Remember what the gurus of the market say: one should buy broken stocks and not broken companies. Distinguishing between the two is critical. What is the difference? A broken company is somebody who has a problem in their financials, problem in their cash flows, problem in their debt, problem in their sources of financing, etc., etc. So if I buy a broken company, the stock can go down and down and down. What is a broken stock? A broken stock is where the company is fundamentally strong, but there are rumors in the market. The rumors actually create emotions in the market and pull the stock price down, though the intrinsic value is very high. So I'm okay by buying broken stocks, because once that rumors are gone, that effect is gone out of the market, the stock price will again appreciate and go back to its original level. But a broken company, unless it is bailed out, nothing can happen about it. Other investments, typically alternate. So you have art, paintings, artifacts. These are attractive because there is one, that it is a fancy holding. So obviously, if I have art with me, I can show off. Second, it's a long-term opportunity. The profits can be huge here. Unfortunately, this is an area where valuation methods are not established. Market is unregulated. They provide only capital appreciation to you. And if anybody wants to get into this, there are art and based investment funds also available. Rating scale, obviously, AAA being the highest rated, D being the default rated. So I hope we are aware of this. Channels for investment, basically two broad channels, direct and through a managed portfolio. In the direct area, you have got the RIA, and in the managed portfolios, you have MF, PMS, and AIF, three categories. What is PMS? This entire book is about that. What is AIF? We'll look at it in the next two slides. So, alternative investment funds or AIFs. What are we talking about here? So, what is an AIF? AIF is a privately pooled investment vehicle which collects money from sophisticated investors for investing it according with a defined investment policy for the benefit of its investors. So what is AIF? Unlike a mutual fund or very similar to a mutual fund, to start off, it is also a pooled investment vehicle. That is, I collect money from many investors. As compared to MF, what is the difference? MF is a public pool, AIF is a private pool. MF collects money from retail investors mostly. AIF collects money from sophisticated investors. And those investors understand the risk return matrix as well. Pool is for the fund is pooled from select investors and not general public at large like you have in the MF. Minimum investment in an AIF is 1 crore rupees. And institutions and HNIs who understand the nuances of high risk taking and complex investment strategies are the ideal customers here. So once again, AIF is privately pooled, collects money from sophisticated investors, and invests in according to the objective of the company. Types of AIF if I have to look at. So three broad categories. Cat 1 AIF, what is it? Here we invest in a startup company or an early stage venture or a social venture or an SME or infrastructure funds. Typically anything which receives a special incentive from either the government, which is state or central, and the regulators. Also, if they feel that this is socially, economically desirable, then that is also a part of your AIF. Similarly, venture capital funds, SME funds, social venture funds, infrastructure funds, and special situation funds, all of these form a part of category 1 AIFs. We'll jump to category 3. It is an AIF that employs diverse and complex trading strategies. It may use leverage by the use of derivatives. It may invest in listed or even unlisted companies. So here what happens is, I use diverse and complex trading strategies. I may use leverage. I may use derivatives. I may invest in listed or unlisted securities. Classic example here is hedge funds. Coming to category 2 now. Category 2 is very simply defined as something which does not form a part of category 1 or category 3 AIFs. Plus, they do not undertake leverage or borrowing other than what is required for day-to-day activities, and or they are as permitted by the regulator, and also they don't do any derivatives. Leverage is that only. So what is not included in 1 and 3, plus where we do not take leverage or borrowing or derivatives other than as prescribed by the regulator or day-to-day affairs, that is a category 2 AIFs. So classic example of this is private equity funds or debt funds which do not receive any special incentives or concessions by the government, regulators, or any other body.